Welcome to Rays of Hope, where inspiration meets possibilities. Join us on this journey as we explore videos that illuminate the path to positivity, resilience, and success. Protect your savings, understanding liquidity risk and your money. Have you ever wondered how safe your money really is? Liquidity risk is a crucial factor that can affect your financial stability, and yet, it often flies under the radar. This video will dive into what liquidity risk is, why it matters, and how it can impact your hard-earned cash. We'll break down the key aspects and offer practical tips to help you protect your assets. Get ready to understand a vital but often overlooked piece of your financial puzzle. Let's ensure your money works as hard as you do. Understanding liquidity risk. Liquidity risk is a crucial concept to grasp when it comes to managing your finances effectively. Let's dive into the definition, importance, examples, and factors influencing liquidity risk to better understand how it impacts your money. Definition and importance of liquidity risk. Liquidity risk refers to the probability that an individual or entity may encounter difficulty in buying or selling an asset without causing a significant loss in its value. In simpler terms, it's about how easily you can convert an investment into cash without affecting its price. Understanding liquidity risk is vital because it helps you assess the ease of accessing funds when needed and the potential impact on your investment's value. Examples of liquidity risk in financial markets. One common example of liquidity risk is when an investor holds a large position in a less liquid asset, such as a small cap stock. If the investor needs to sell the stock quickly, they may struggle to find a buyer at a favorable price due to limited market participants. This can lead to selling the asset at a significant discount, resulting in a loss. Another example is in the real estate market, where a property may be considered illiquid if there are few interested buyers. In such cases, selling the property quickly may prove challenging, exposing the owner to liquidity risk. Factors influencing liquidity risk. Several factors influence liquidity risk, including market conditions, asset type, and investor behavior. Market volatility and uncertainty can impact the ease of buying or selling assets, leading to increased liquidity risk. The type of asset also plays a role, as some assets, like government bonds, are more liquid than others, such as real estate or art. Moreover, investor behavior, such as sudden mass selling or lack of interest in a particular asset, can exacerbate liquidity risk. Understanding these factors can help investors make informed decisions to mitigate liquidity risk and protect their financial well-being. Assessing liquidity risk. Assessing liquidity risk is crucial in managing your financial assets effectively. By understanding the potential challenges and opportunities regarding liquidity, you can make informed decisions that align with your financial goals and risk tolerance. Methods for evaluating liquidity risk. One method for evaluating liquidity risk is analyzing the time it would take to convert an asset into cash without significantly impacting its market value. This can be done by assessing the ease of selling an asset quickly in the market without causing a drastic price change. Another approach is to consider the correlation between market liquidity and funding liquidity to evaluate how external market conditions could affect your ability to access cash when needed. Tools and metrics used in liquidity risk assessment. Various tools and metrics are employed to assess liquidity risk effectively. One common metric is the liquidity coverage ratio, LCR, which evaluates an institution's ability to meet its short-term obligations. Stress testing tools are also utilized to simulate different scenarios and measure how resilient your assets are to sudden market shifts. Additionally, cash flow projections and liquidity gap analysis help in predicting future cash needs and identifying potential liquidity shortfalls. The role of stress testing in liquidity risk management. Stress testing plays a vital role in liquidity risk management by preparing for adverse scenarios and mitigating potential risks. By subjecting your portfolio to various stress scenarios, you can assess how it would perform under challenging market conditions. This proactive approach allows you to identify vulnerabilities in your liquidity profile and implement strategies to enhance your financial resilience. Stress testing helps in ensuring that your assets can withstand unforeseen market fluctuations and liquidity pressures, safeguarding your financial well-being. Managing liquidity risk. When it comes to managing liquidity risk, having a well-thought-out strategy is essential to ensure the availability of funds when needed. Let's look at some key aspects that can help in mitigating liquidity risk effectively. Strategies for mitigating liquidity risk. 1. Maintain adequate cash reserves. Keeping a sufficient amount of cash on hand can serve as a buffer during times of financial strain. 2. Establish lines of credit. Having access to a line of credit can provide a quick source of funds in case of unexpected liquidity needs. 3. Monitor cash flow. Regularly tracking cash inflows and outflows can help in predicting potential liquidity issues and taking proactive measures. 4. Diversify investments. Spreading investments across different asset classes can reduce the impact of liquidity constraints in a specific market. The importance of diversification in liquidity risk management. Diversification is a crucial element in managing liquidity risk. By spreading investments across various asset classes, industries, and geographic regions, investors can minimize the impact of a liquidity crisis in one particular area. Diversification helps to ensure that funds are not overly concentrated in illiquid assets, thereby enhancing overall liquidity management. Regulatory requirements and liquidity risk management. Regulatory bodies often impose certain requirements on financial institutions regarding liquidity risk management. These regulations aim to safeguard the stability of the financial system by ensuring that institutions maintain adequate liquidity buffers to withstand potential stress scenarios. By adhering to regulatory guidelines, institutions can enhance their resilience to liquidity risk and contribute to overall financial stability. Investing and liquidity risk. Investing always involves some level of risk, and one key aspect to consider is liquidity risk. This risk refers to the possibility that an investor may not be able to access their funds in a timely manner without incurring a significant loss in value. Understanding how liquidity risk affects investment decisions is crucial for building a robust investment portfolio. Thanks for joining us again. In this second part, we'll explore practical strategies for mitigating liquidity risk and protecting your savings. From building an emergency fund to diversifying your investments, we'll cover essential steps to ensure your financial security in the face of liquidity challenges. Stay tuned. Thank you for joining us on this uplifting journey with Rays of Hope. Please comment, like, share, and subscribe to stay tuned for more videos that spark hope and empowerment.